Hi there and welcome to Option Pit. I am Mark Sebastian, the founder of OptionPit.com, and I want to remind you that this is for educational purposes only. Anything you hear is for education. It is not a recommendation. Move forward at your own will. So, today we're talking about trading direction, the Option Pit method, using volatility to improve directional trading. This is me if you don't know who I am. I am Mark Sebastian. I founded Option Pit. I run a hedge fund called Carmen Line Capital that does volatility arbitrage. Option Pit is an education and consulting firm. All right, we work with retail traders, teaching how professional traders trade. Just like, at one point in time, I was a retail trader. I got hired by Group 1, and they coached me up and taught me how to trade. That is what we do, all right? On the professional side, we will work with hedge funds, money managers, you name it, teaching them, working with them to implement option strategies or test option strategies. I've worked with clients that are managing $15 billion. I've worked with clients managing $1,500. That is what we do here. We are the best in the business, hands down, and I'm very proud of that. So, directional trading. Volatility can act like a headwind or a tailwind to successful trading. We're going to talk about basic buy-sell decisions. I'm going to teach you about strike selection. I'm going to teach you some combination trades that I really like, some trade approaches that I use, and I'm going to teach you a little tip for day traders and swing traders involving VIX. All right, options and stock. The key to trading options for direction is correlation. Correlation means how one instrument moves with another. All right, so for instance, if I tell my wife that I don't like her dress, there's 100% correlation with her getting mad at me. All right? They correlate it, her anger and me insulting her clothing correlate at 100%. All right? So, a correlation of 1 or 100% means the two will move perfectly together. All right? So, the correlation of an option can never be more than 1 or less than -1 to its underlying. So delta, all right? Delta is the option trader term for correlation. In math, it can also be called slope. Delta can change with the passage of time, change in price, or other important factors. People say, why do option traders call correlation delta? And my theory is that it sounds cooler. So it's unconfirmed. But I would agree that delta does sound cooler than the correlation. The Army has a delta force. It doesn't have the correlation force. So delta can be described in a lot of ways. The most common use is the correlation, as I discussed above. Thus, an option with a positive 0.6 delta will make about 60 cents for every dollar the underlying rallies. It will lose about 60 cents for every dollar the underlying falls. All right. What makes delta so hard, all right, is that relative to a stock, it can change on a trader. All right. There's some drivers in change of delta that are easy to understand, like price movement and passage of time. All right. One that can have the greatest effect on the performance of delta of a directional trade is volatility, and that's what we're going to talk about. So this is kind of this is not my best drawing, but it's the best drawing I could come up with of kind of how delta moves with an underline. It's not the best drawing, but it's kind of a basic drawing of how these things move. All right, the green line represents the stock price, the blue line representing the options price. All right, so now let's really dig in here. All right, do we all have a decent understanding of delta and what it means and how it moves? So has this ever happened to you? Because I get this all the time. Mark, you market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money. You market makers are cheating me out of dollars. You're taking money out of my pocket. And the fact of the matter is, all right, that nobody took your money. The underlying correlation changed on you, and that is because of volatility. All right, so the Greeks, which are our risk management pieces, are produced by a pricing model. All right. Thus, they're what we call modeled risk. All right, and there are all sorts of things that are modeled. All right. So they're meant to help us manage the risk of given option positions. However, the Greeks are an output of the model. They are not an input. Thus, they're not a hard number. So, you ever heard the term garbage in, garbage out? All right. Or, there's some really interesting interesting examples of terrible modeling. You've got bad modeling in, we've seen bad polling. That's bad modeling. You've seen bad, all sorts of different things. All right. Garbage in, garbage out. So really, the fact that the Greeks are from a model creates a problem. All right. All right. So the key to understand is that delta is an output of the model and is modeled risk, and it's a modeled risk. Thus, picking the right option for directional opinion is key. Should an option be bought or sold, in the money, at the money, or out of the money? It all depends on the implied volatility. So let's talk about what implied volatility is. All right. Implied volatility is what we use to produce the Greeks. That delta, that correlation, is directly related to implied volatility. So what makes trading volatility different than trading a stock? And the answer is, over the long term, we know where implied volatility of a stock or index is going to go. We don't know where the stock price is going to go. Implied volatility is mean reverting. So here is Apple. All right, does it really look like there's a mean or a discernible pattern to this stock price? The answer is no. Now, take a look at VXAPL. Now, what is VXAPL? VXAPL is the VIX of Apple. All right, pretty simple. All right, when we see kind of that 200-day moving average doing nothing, that's a decent sign of mean reversion. If I wanted to draw a line on mean reversion, I'd probably say, the long-term mean for Apple vol is around 28.5, maybe 28, something like that. That might be my line. All right, and that is the thing to understand with volatility. It reverts back to a mean. So we've got a question is can we see that in Thinkorswim? A lot of what I'm looking at you can't see in Thinkorswim. The charts that we're going to be using tonight are from what's called Live Vol Core, and it is an incredible piece of analytics software that comes free with Tradier. And I'm going to put out a kind of a cool offer at the end around Tradier, and I think you guys are going to be impressed. Now, can you pull up VXAPL on some of the other brokerage firms? Yes, but I think some of the charting you get from Live Vol Core is far superior. VXAPL is the VIX of Apple. And if you've never heard of VXAPL, then it's time to learn. So now let's talk about that concept of mean reversion. And this is the thing to remember. All right? A stock price can go anywhere, but it can't stay there. All right? It just can't stay there. All right? It must revert to its mean over time. So understanding that mean reversion and that buying and selling is key. All right? When vol is high and when vol is low. So now let's talk about this. Directional trading. So let's talk about some basic buy and sell decisions. I'm going to talk about that delta piece. In general, when implied volatility is low in the near term and especially in the long term, and one wants to play a direction, it makes sense to buy options instead of to sell options. So when implied volatility is high or normal, it makes sense to sell options. All right. So when implied volatility is in kind of, if you were to go into quartiles, if you will, I'm actually going to make it even easier. I'm going to go into thirds, trimesters, or whatever you want to call it, instead of quartiles, quarters. So if I were going to split volatility in three pieces, really high vol, normal vol, and low vol, I want to sell premium generally when volatility like VIX is normal or high, all right, unless it's too high. And when it's in that lower range, that's when it makes more sense to buy. Now, it's not that simple, but that's generally a way to think about it. Don't get so excited to sell premium when volatility is in the toilet, is kind of my main point. And that's the important piece. Covered or naked, it does not matter. All right. Generally speaking, it makes sense to buy spreads when volatility is low instead of selling them. So let's talk about it. All right. So when you want to go long the underlying, you can buy calls or sell puts. All right. Each trade acts very different. All right. Even though you're getting the same delta, they may act very differently. So let's kind of talk about that. All right. So when you think about the Greeks, all right, the Greeks, all right, they're an output of this pricing model. And the pricing model states that the option price, all right, equals, it's a much more complex formula, but basically they take the option price equals the underlying price, the strike price, the timed expiration, the cost of carry, and forward volatility. All right? And they're put into some crazy calculus program called the Black-Scholes model that spits out that option price. Now, here's the problem. We know underlying price. We know strike price. We know the timed expiration. We know the cost of carrying. Do we ever know the forward volatility of an underlying? What do you think? No, we do not know the forward volatility. All right, so then this becomes, all right, but you know what we do actually know though? We know what price this option is trading for. So we now have the option price. So we've got this price. And then we basically do a crazy calculus algebraic formula, bring the option price over, and we bring forward volatility onto this side and solve for it. And that is what implied volatility is. Implied volatility is derived from the option price and the four factors we do know. And that's the key. So now, if you understand this, now you understand why we're looking at implied volatility. Implied volatility is created by humans. It's not created by some perfect thing, and that's why you need to pay attention to that volatility level. So thinking about a short put, I know so many people that are like, I sell puts, I sell debit spreads, I sell credit spreads. All right, I just sell puts and put money in the bank, okay, until we run into August or last week. All right, a short put is long Dalton, short Vega. Thus, the trader is actually hoping the stock moves higher and implied volatility comes in. All right, you want IV to drop. So now, what makes implied volatility drop? It drops because movement drops. All right, it drops because expectations of movement fell. All right, thus, a short put is actually a play on lower realized volatility. All right, so when you're selling a put, you're not betting that the underlying is going to go up. You're betting that the underlying is not going to go down. All right, you're taking advantage of expectations of implied volatility and movement dropping. That is how that put is going to make money. So here's JP Morgan. Here's another vol chart. Now these proprietary vol charts from Live Vol Core are basically unavailable on Thinkorswim. All right, or even Interactive Brokers. Nobody really has this type of kind of precision data. And what I want you to notice is that, notice how implied volatility is kind of elevated in here. And meanwhile, JP Morgan is right around 55 bucks. All right. And so with the volatility higher, it makes a lot of sense to sell a 55 put because you're, one, confident the underlying is not going to go down, but you're not necessarily confident that the underlying is going up a lot. That 55 put can do extremely well. All right. So now, long calls. Our long call is long delta and long Vega. So a trader is hoping the underlying volatility goes up and volatility goes up. So what makes that happen? Movement. An increase in movement, an increase in expected movement. When you buy calls, you are betting volatility is going to increase. You are going long volatility premium. So here's Alta. This is another one. All right, Alta, they make makeup. Or they sell makeup. And they make it. My wife's a fashion blogger. She is. Yeah, they private label and sell other people's makeup. And they're very good at it. And what I want you to notice is here's a case where Alta, after kind of sitting in a range, they kind of just murdered the implied volatility down to here. All right. And you look here, you say, look at this starting to move a little bit, starting to rally a little bit, and the volatility staying cheap. This was an excellent chance to buy calls. The best part is you buy calls, and not only does the underlying rally $15, the implied volatility goes straight up too. Winner, winner, winner. All right. This is that long call. This is a great opportunity to buy calls. No, this was an opportunity. This was one where we bought Alta calls because we thought that Alta was going higher. Because this is from October. All right, so this is a couple weeks. This is about 3 weeks ago when Alta was trading about 150. And this is one that made it into the option pit strategy letter. So what makes IV go up? Expectation of movement. All right, or an actual increase in movement. Those are the two things that really push volatility. All right, so now let's talk about getting short. Like going long, when one is making buy-sell option decisions, you have to take implied volatility into account. If implied volatility is high and one thinks the stock is going to go down, sell call spreads. I really don't like naked short calls. It's not one I like to do. But I definitely like selling call spreads when vol is high. And when vol is super low, buy puts. And that can happen. All right, I can tell you a lot of examples of really low implied volatility and a sinking stock. All right, I'm going to show you how to use these vol charts to come up with trade generation here in a minute. So this is IBM. IBM, piece of junk. Talk about a CFO that should be fired. The way they botched their stock buyback program is borderline unfathomable. But, so IBM has earnings, and the stock drops, but it doesn't drop that much. Great opportunity to sell calls. What happens? IBM basically sits below 165 the whole time, and all you do is sit there and play with sinking volatility. And then when it gets to kind of a certain level, maybe you would look to buy puts here. Here's another opportunity. IBM tank, kind of a V-tank rally. Starts backing off again. I get that nice, juicy 25% premium, and I sell a 165 call. It's an excellent opportunity to sell premium. So the question is, when volatility is high, does that mean, or low, does that mean market makers are complacent? No, it typically means that customers are complacent. It means that there's a lot of people selling a lot of premium. Do I care about support and resistance levels like 50-day and 200-day SMA? I do. If you look at the red line here, this red line is the 50-day single moving moving average. The green line is the 200. The gray line is the 200-day moving average. So I pay a lot of attention to those. All right. I have so one of the things is, what is low vol? 15, 30. It depends on the stock. Every stock has its own volatility. And, the value of these vol charts is I can get 30, 60, 90, and I can also get HV. And this is calculated in a really smart, derived way. It's not just standard kind of VIX calculation. I rely on these charts substantially. And getting these charts kind of well overlaid with candlesticks is really valuable to me. I don't think that you can get all the different moving vol charts that you can get in OX. Plus, wait till you hear the rate that they charge. All right. Now, buying puts. Here's an opportunity to buy puts. IBM, again, getting pounded. Bad earnings, drop some more. They overkilled the earnings here. Look at this. Implied volatility way too low. They drop it all the way down below 16. One thing I know, when IBM volatility gets below 16%, it's time to buy options. You can see these put buys work pretty nice. Been a rough stretch for IBM. IBM may end up touching 100. So that means people are willing to be assigned the stock, which is counter to put buyers? No. When you mean buy put, what days to expiration? Well, this is a 30-day chart, so I'm usually looking about 30 to 60 days out for my directional plays. No, typically, when people are selling stuff, it's not about being assigned. It means they're dumping premium. It's covered call writing. It's overwriting. It's put selling. Retail customers, institutional customers are grasping for income. And so they tend to overshoot things some. So any questions about using volatility? About how to dig in volatility? No. All right. So now let's talk about strike selection. So now that you've determined, okay, I want to buy something or I want to sell something. Is it that easy? No. No, it is not. All right, the next step is to select the right strike. All right, and this is done based on the certainty of the next implied volatility move. When one believes that implied volatility is going to go up, you buy softer deltas, and I'll explain what those are. And when one believes that implied volatility is going to be stable or go down, you use what's called a harder delta. All right, a hard delta is relatively resistant to change in volatility. All right, so if implied volatility changes, its movement isn't going to change that much. All right, hard deltas are typically in the money and at the money options. A soft delta is a delta that's going to be relatively dependent on a change in volatility. Soft deltas are out of the money and far out of the money options. All right, and understanding the difference will help with strike selection. And I'm going to talk about the buy side, and then I'll talk about the sell side. So when would I want to be long hard deltas? When would I want to own a hard delta? So when one isn't sure of the vol move, when one IV is very high, and when one isn't sure the severity of the expected move but wants to limit risk. So here's Goldman. And look at how high volatility is in Goldman Sachs in this trade. And this is older, but it's such a good example of it. All right. So Goldman trading around 115. Look at that volatility into the 30s. So I've got two options here. All right. Obviously, this is last year's Goldman, not this year's. I can buy the Goldman Sachs D110 calls for $7.60, or I can buy a bunch of the 125 calls for 96 cents. We can see Goldman rallies, and my options both went up. So let's see what did better. All right, so on the 15th, Goldman Sachs is trading 115.44. I buy one Goldman Sachs December 110 call for $7.60. That is 70 deltas. All right, so I bought 70 deltas, and I spent $760. All right, where do I get that number? Right there. There's that delta number. Or if I want to spend similar dollars, I can buy 8 of the December 125 calls and spend $768. And I'm getting along 130 deltas. Now, where do I get 130 deltas? Well, what's 8 times 17? So now, 8 days later, Goldman's up $5. My December 110 call is worth $10.65. I made a $305 profit on a one lot. That's close to 50%. All right. Or I can do my 8 125 calls that are $1.19, and I make $184. So let me get this straight. I bought twice as many deltas. Look at this. Twice as many deltas, and I make half as many dollars. What changed? Right here, folks. Look at that implied volatility fall. The hard delta is the better trade. So now, softer deltas are more sensitive to changes in IV. And there's some very specific times where they can make a lot of sense. I purchase them when implied volatility is really low, when I'm looking for a major move and I'm looking for a cheap bet. All right. Now, I don't do a cheap bet when IV is high, because that's not a cheap bet. But I'm looking for a major move in the low vol. So here's an older, look at this IBM when it's at 190. Look at that. All right. Now, the reason why you're seeing a lot of Apple, IBM, and Goldman is because they all have VIX indexes. There's VIX IBM, VX IBM, VX APL, VX GS. So I think IBM's going higher at this point. All right, so I have an opportunity to buy a hard delta, which is an option that's somewhat in the money. So I can buy the December 185 calls for $680, or I can buy a soft delta, which is the 195 calls, which is out of the money. And you can see a couple days later, I was right. All right, my 185s are worth $9.30. My 195s are worth $2.25. So let's take a look. My 185 calls are 75 deltas. See right here. If I buy one of those, I spend $680. Now, alternatively, I buy 5 of the 195 calls for $1.22. I spend $610, so $70 less, and I'm buying twice as many deltas. Right? 5 times 29 is 145. Well, a couple days later, IBM's up over $3. My 185 call, I made $2.50 on. Great. Great, you won. But take a look, my 195 calls more than doubled the profit despite spending $70 less on the trade. That out of the money, that soft delta was the better trade. And that's because the implied volatility was low. Key is don't be greedy as well. All right, so the same logic for hard and soft deltas can be applied for option sales. Just flip it. So when you think implied volatility is really high and you want to sell an option, you sell out of the money options. When you're not sure where implied volatility is going to go, or it's relatively low, sell a firmer or a stiffer delta, more of an at the money option. All right. So now let's talk about how I put these two together. And I'll tell you, I use the Pro Scanner in LiveVol Core that gives me all sorts of scans. All right. So what I look for is stocks where the implied volatility is at a 52-week low, and the stock itself is at a 52-week high. I also will use the VIX methodologies, and I buy the first call that is out of the money. So let me show you. Here's Goldman. See, there's that low VIX. And you see, I buy an out of the money call, and the underlying goes straight up. Now here's one in Tesla. Tesla, you know, it's not at a 52-week high, but I'm looking at that volatility here. You know, I'm looking around in here, and I'm looking at that low vol. And I'm saying, boy, this is an opportunity to buy calls, especially coming up on this big move. So you can see they just plummet volatility. So the volatility gets really low. Perfect opportunity to play a momentum trade higher with long calls. You know, breaks over its 200-day moving average, gets healthily above it. You can see that you get the cross here, and the vol stays low for a while. Great opportunity to buy calls. I don't even like Tesla, and I would have bought calls there. So now here's trade 2, and this is a trade that works really well. All right. So when IV or VIX methodology hits a 52-week low and a stock hits a 52-week low, buy puts. Buy the second put out of the money. All right. So if you think vol goes up, does that indicate you could go? It could go down? Well, no. That's the nice piece. When stocks are at their 52-week high, where do they tend to go? Higher. So what I typically do is I watch the stock hit the 52-week high. I see the volatility of 52-week low. I wait a day because usually it backs off, and then I buy calls. I mean, it almost always works out. Super easy. All right, now, And it's typically because there's too many people overwriting, and so the calls get overly cheap. So now what about, and what'll happen is that call will kind of hit the short strike. So if you look at Tesla, probably a lot of call overwriters right here around the 200-day moving average. Just erase here. So you probably got a lot of people kind of overwriting at this 250 strike. So if you buy the 250 call, once it breaks, it really breaks because people are racing to cover. So when a stock hits a 52-week low and the implied volatility hits a 52-week low as well, that is the time to buy puts, the second put out of the money. And why? Sinking IVs and sinking vols almost always mean the stock is going lower. Why? Why do you think vol drops? Why do you think vol dropping and a stock dropping is bad for the stock? Implied vol. Well, what makes the bid for puts go up? People are doing what? They're hedging. They're hedging. So if a stock is dropping and implied volatility is going up, is going down, what's going on? People are selling the stock and not hedging it. So I use the scan. I look for stocks that are a 52-week low, and I look for, at the same time, them to have a 52-week low implied volatility as well. So I'll show you an example here. And here's GLD. People want to know what I think of gold? I think gold's got some problems, because take a look here. It's just sinking, 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 sinking. And look what they're doing to implied volatility the whole time. One of the easiest scenarios of put buying ever. And you can see they started to do it again here. Look, the vol's dropping as the underlying is dropping. And then what happens? Look out below. People want to know where I think gold's going? I think gold's going to be, I think this time next year, assuming the Europeans keep up what they're doing and we keep up what we're doing, you're talking about $800 an ounce. So now here's the final trade that I'm going to tell you about as a volatility trader. So anybody here like to day trade S&P minis or anything like that? So what I would encourage you to do, one second here. All right, is start paying attention to VIX futures and VXX. And the reason why is VXX and the VIX futures almost always lead SPY and S&P futures. Almost always. So what do you look for? I'm going to show you. When you see a choppy market like this, and at the same time, so this is SPY, and at the same time, and this is a tick chart here, and at the same time you see VXX slowly rallying, the market is setting up for a serious dip. It may take a little while, but I run these two as a tick chart against each other. And when I see vol rallying and the market not doing anything, I'll start to look at buying puts. When I see vol dropping and the market not doing anything, I will either look at selling puts or buying calls. So notice that even though SPY is flatlining, VXX is slowly rallying. All right, it is one of the strongest indicators you can possibly see that the market's going to drop. This is the kind of stuff that we do at Option Pit. So in summary, volatility reverts. Implied volatility helps more positions. There are different types of delta for different positions. Understand hard and soft deltas, and remember that VXX and VIX futures lead S&P. So here's what I would say. One second here, folks. Get rid of that note so I can drop in the copy here. So what I want to talk to you about is this offer that I'm going to make. And Tradier gives you Live Vol Core for free. Now, Live Vol Core, if you are a professional customer, costs $100 a month on its own. It is recorded. And then I will answer questions after this. All right, so Live Vol Core costs $100 a month. You get it free and can generate a trade ticket directly from Live Vol Core. On top of that, here's the special deal we're going to give you. And this is only through my relationship with Tradier. All right, if you open up an account with as little as $1,000, on top of getting Live Vol Core for free, I'm going to give you 3 free months of Option Pit Live. Now, what is Option Pit Live? Option Pit Live, you get access to our chat room, and Andrew, who's my number 2, and myself are on for around 3 hours a day on our own, plus we have other pros in there all day. You get our strategy letter. Now, what is our strategy letter? Our strategy letter follows trades from start to finish. So you get to hear us learn about why we put on a trade. You get to learn about why we take it off, how we adjust it. And we actually develop the trades in the chat room so you can watch me and Andrew developing trades. Then we put them on the strategy letter and we follow them from start to finish. All right? And we use Live Vol and Live Vol Core pretty extensively in our chat room. And Option Pit Live is $125 a month. You're getting 3 months for free. But as a free subscriber, we're doing what we call our Saturday classes. And once a month, we just had one, but once a month, our next one's going to be December 5th. That's Saturday. We do a 4-hour class on Saturdays where we cover something in detail. On December 5th, we're going to do using options to trade for direction. All right, and it's going to be 4 hours of directional trading education. And we sell those at $247 retail. And even when they go on special, they're $147. And you get them free. Does Tradier support futures options? I do not know. That is a good question for them. I don't work for Tradier. All right, now, here's the thing. Unlimited option trades, they do have a minimum. I think the minimum is $1.50. 35 cents a contract. $3.49 per equity trade, and you could open it up with $1,000. So think about this. You open an account with $1,000. Even if you don't use the option pit stuff, the Live Vol Core pays for itself in 10. Yes, IRA transfers do qualify. They don't take Canadian counts, unfortunately. They want to. That's in the works, is my understanding. So you get customer support. You open with $1,000. You get what amounts to about $900 worth of free stuff from me and Live Vol Core for free. And all you have to do is, and 35 cents a contract. It's kind of silly. Starting next year, Option Pit's actually going to offer auto trade through Tradier as well. So if you like our strategy letter, you will like this. And if you want to see a little bit of what Option Pit's back end looks like, I can show you what the strategy letter looks like. It's pretty neat. So, you know, we do buy right dividend captures. You know, some things like that. We do some really, so you can see, like, you'll see the trade generated. So we're doing long stock, and this was a trade from today. We did a long stock with a covered call against it. And the idea was to generate a 4% yield with dividend capture. We'll also do things with VIX. We did, you know, we'll do UUP calls versus USO, SPY versus SPXY. We do some really cool trades. We've done, and on top of that, when I say that we keep track of all of our trades, we literally keep track of all of our trades. You can go and see our portfolio. What do we have on? What do we have it on at? And we actually keep track of whether we're making money, how much we've made month to date, year to date, things like that. So I've posted in the chat and in the where you can get this. So any questions? I saw some good questions. Okay, how does one decide IVs are high? So what I typically do is look at kind of a 1 year or 2 year chart. And then I also will look at where VIX is. So when the VIX is at 12 and implied volatility is really low, well, then that can kind of make some sense. But I'm typically looking at kind of where things are within their percentile over the last 3 to 4 months and where they've been lifetime. So I'm looking at a 3-month chart and a 2-year chart typically, and kind of to figure out where implied volatility is low. Thank you. Can I review SPY versus VXX? So what you're going to do is monitor VXX. And when VXX is rallying and the SPY isn't doing anything, yeah, here we'll send the link out, of course, but here's a copy of the link right here. When SPY is sitting, just kind of churning, and implied volatility is slowly rallying via VXX or the VIX futures, then it's very likely that SPY is going to drop. All right. So that is really the key. So I think you can. This offer that void were prohibited, right chance, trade reserves right to pass through exchange, additional. I bet you can. I'll bet you they can make that happen, Michael. What happens after 3 months? After 3 months, you can continue to have your services. I'll talk to. I know that they can open IRA accounts, so. But you may have to open it with a little more or something like that. I know I'll honor my end with an IRA. So what happens after 3 months? After 3 months, if you want to keep your subscription, then there's a monthly charge. If not, you can just cancel. What do I think of the recent multi-day rise in VIX and SPX? That was crazy. It really looked like it was all around Fed, and now that the minutes are out, I feel like volatility is going to get sucked out like a balloon going into Thanksgiving next week. Suppose you have a great sell level, yet you want to be safe. So do you start with a spread? Yes. All right, I would always use spreads anyway, generally speaking. So once the stock starts dropping, do you remove the offset unit? You're in a naked long put trade. Does that make any sense? And IVs are low. Yeah, generally speaking, I use put spreads. I don't use naked puts very often. But yes, same concepts apply. Absolutely. That eats profits, yes, but on a profit per dollar. So if you look at the yield of the trade, it's a lot higher. Whereas a cash secured put costs a lot of money, the spread may not be very much. But nobody quote me on the IRA stuff. You'll have to, but you might have to open with more money than $1,000 in the IRA account. That's my guess. All right. So who's excited? So think about this. You open up quickly. On top of getting Live Vol Core for free, you're going to get my next class, which is December 5th for free. That's $150 right there. And you're going to get 3 months of our service. We're going to do another class in January. We're going to do another one in February. It's going to be a lot of fun. All right, guys. Any other questions? Yeah, we're talking about doing a trade adjustment one coming up soon. And then we're probably going to talk about doing a beginner boot camp. How do you learn Live Vol Core? I'm happy to work with you for your client. It's actually relatively intuitive once you get used to it. All right, guys. I hope everybody has a great night. If you got questions, you can email me, mark@optionpit.com. Yes, they are. And our gold members actually get all of our monthly classes, past and present, while their gold membership is active. So that's a whole nother story. All right, folks. I hope everybody has a great day. You can email me, mark@optionpit.com, if you have questions. You can call our office, 888-TRADE-01. That's 888-872-3301. Or reach out to Tradier if you've got questions about this. You can shoot me an email if you've got questions about gold. All right? All right, folks. I hope everybody has a great night. There's going to be an encore of this webinar on Monday that you'll see, and then we'll put the recording out after Monday's webinar.